Hello, welcome to the Market Cover. I'm Adam Harter, Chief Investment Officer, along with Andrew Thrasher, Chartered Market Technician and Portfolio Manager. Thank you, as always, for giving us a few minutes of your time here. We would just want to share some of the things that we found important as we went through this week's investment allocation, as we do each and every Monday. So we got three topics for you this week. We're going to talk about supply chain pressures. And before you ask, no, this is not a stale copy talking about 2020 or 2021. We just want to keep that topic at the front here and look at it from a new angle and hopefully one that'll come and pass. But we'll see. Then Andrew's going to cover annual asset allocation, annual asset class returns, and sector rotation and its importance into our model. So let's start with the supply chain pressures. So one of the great things about 2023, or what allowed a really strong rally into the end of the year, was this decline, much more than anybody anticipated in inflation. And a good reason for that is we really seem to finally have in full a strong and across the board healing of all the supply chain issues that began and were thrown off whack with COVID. Of course, there's more at play, and oil certainly as a headline factor for bringing inflation down. But one big part is we finally had the world working as it should have been. To start off this year, we do have one concern that could throw a monkey wrench into that plan. So hopefully not something that would send it completely into reverse or chaos, but it's certainly a headache right now. And that is the conflict in the Middle East. So what we have here is a chart of the boats in motion. So typically what you'd have are a lot of the massive goods that come from China, often shipped through the Red Sea as a shorter route in there to Europe. But because of the conflict there in the Middle East, they have been rerouted around the south of Africa. And the significance there is you add about 10 days. That is an expensive 10 days when you're talking about a crew and cargo and other transportation costs. So we look for that to not be a sustained deal, or else we could have issues and something that could add a little bit to the inflation pressures that we had. Hopefully not something to reignite. But one of the hopes and the anticipations of this year is that we would turn the page and the Fed could reverse some of the rate hikes. This is one of those factors that could throw a wrinkle into their plan. If there was something that lifted prices even temporarily, could be a problem. So there could be something that come and pass. A piece would go a long way. But for now, these boats are taking the long way and will likely add some cost somewhere to some buyers. So that's an economic update for you. I'll pass it over to Andrew to talk about asset class returns and visit 2023 one more time.
All right, thank you, Adam. So last week in the Market Carver, I was here with Zach, and one of the topics that we went through was looking at the performance of different asset classes or different types of investments in just the year 2023. Now we're going to take a little similar topic in conversation. We're going to look at an asset class quilt, and you'll see what I mean when you see the graphic on your screen and why it's called an asset class quilt, because what it's showing here is different types of assets that you can own from different years. As you can see that some things that perform really, really well one year might not have had the same type of performance the next year. For example, in 2022, commodities was the strongest asset class based off the sampling. And then we move into 2023 and we see that blue shift all the way to the bottom. And it was actually the worst performing asset class in 2023, the best being large caps. There's different things we can pull from this, and this is a big conversation we had in our asset allocation meeting on Monday. But what we wanted to share with you is the importance of active investment management, and why we don't want to just get too focused on one type of asset class, getting too focused on just large cap stocks or international markets, because as the years change, there can be trends and there can be rotation in what is showing the strongest leadership in each year. And of course, this is just looking at one spot in time each year. How is everything as it finished out at the end of December? And a lot can happen intra year. But it's important you can see a lot of things do shift and move from being really strong one year to really weak the next, or you can start having trends to where some things do really well for multiple years. But by having an active approach, by being cognizant of how different asset classes are performing and what's impacting that performance, can allow us to adjust the sails, so to speak, on our ship as we're moving and seeing which way the wind is blowing for different types of investment opportunities. And so as we move into the next year, We don't necessarily know. Will it be large caps once again? Will commodities maybe improve performance? I'm sure there's going to be a lot happening in fixed income that we're going to spend probably a lot of time talking about in 2024. But there's a lot of different catalysts that can impact these returns, and they can have big swings in where they fall in kind of these rankings, creating this quilt, as you see on your screen, of how they different perform relative to one another. Now we're going to shift the conversation from looking at broad asset classes, being a little bit more narrow into individual equity sectors. So we primarily look at the 11 sectors of the S&P 500, and that breaks into technology, communication. You can see the list there on your screen. And this is a really handy table that Zach put together looking at 2023, and he ranked the sectors by best to worst performers. So last year, technology was the best performing sector, followed by communications. The worst performing sector at the very bottom was utilities. And something that we do and has a big driver, big impact to our portfolio management is a sector rotation, an entirely quantitative approach to picking sectors based off primarily momentum and volatility. And we rank them every month and determine which ones do we want to have the most exposure to within our models, within the portfolios. And so what Zach did that we think is really interesting on this table is looking to see where we had exposure to different sectors throughout the year. And thankfully, because technology was the best performing sector, this is actually one of the sectors that we spent the most time having exposure to. In fact, 7 of the 12 months we spent in technology, followed by the strongest sector, or the second strongest sector, communications, was actually the sector we spent the most time in. And you can see is 9 months. And then the green bars show which specific months we were in that sector. And so by having this rotation, by having this quantitative approach to looking at the sectors, allows us to unemotionally evaluate the market, and also with the goal of being in the sectors at the right times that are showing the most strength and allowing us to seek those appreciation opportunities in a year like 2023. In technology, communications, consumer discretionary, all those fall into what we've talked about a lot, those magnificent 7. Amazon, Apple, Microsoft, all those make up these top 3 sectors, and they were the strong drivers in this model. Thankfully, spent a good chunk of time with the overweights being in those parts of the market. But we can see those change, and sometimes we don't see persistent strength in one sector for a full year. We look back at 2022, we remember energy was actually one of the strongest sectors for a good chunk of 2022. Where did it come into this year? Actually, the second worst performer. We saw that it did have a little bit of strength starting out, and we saw our sector rotation model stay in energy at the start of the year. And as it fell out of favor with the market, we saw the rotation model, as momentum shifted, really focused more on those technology, communication, more growth type parts of the market, and we're able to benefit from those types of changes. So we always are seeing the markets are moving pretty quick. They move fast, and we spend a lot of time trying to monitor and look at those and finding the best ways to do that analysis. And we thought this would be interesting to share with you kind of a behind the scenes look of how we're doing some of that work within the different sectors like we're seeing here, or the actual asset classes as we previously discussed. So we continue to do this work for you, continue to work hard as we move into 2024 as well.
Yes, thank you, Andrew and Zach. That was a good chart to put through and a good way to look into 2023 and how effective. Just for all of you, just sharing some of our philosophy. We believe in having a lot of different things working for you. We don't just like to have diversification in big, broad buckets, a bucket of stocks and a bucket of bonds. We want to have different strategies and lots of them, and pile small things into your favor. And the sector rotation is a pivotal piece of that. Now, sometimes we get the question of why do we need so many holdings? And the answer is there that we do like to employ lots of little different strategies there. In 2023, sectors were one of the things that were very helpful and to participate in those areas of the market that were strong. So thank you to all of you for giving us your time this week. As always, we give you a reminder to give us a call, 800-928-4001, or scan the QR code if we can be of service. So thank you again, and have a great weekend.